Today, let's see if we can understand what is going on in the bond markets around the world and what we should watch and what we can kind of expect. I want to be very clear here, though. I don't think we've ever been in a situation like this. I'm talking about the world, including the United States. I don't think anyone really knows what's going to happen out of all this. So, given that I believe we're in a generational changeover economically, politically, socially, militarily, it still leaves us down to kind of like reading the tea leaves and to see what we can ascertain is actually going on in the markets. First, we understand that the yen is moving up and their bonds are moving down. So why don't we take a look at the JGBs and see just who owns them? So there's a total of 1.2 trillion outstanding. The Bank of Japan, the BOJ, they own 46%. Insurance companies own 15.6. Foreign investors own around 11.9. I would imagine they're the yen carry trade. And then there's the Japanese banks hold about 14.5%. You add that up, it's like 90% of the bonds. We know exactly where they are. And if you want to look at that graphically, you can see it here. Other financial investors is that darker yellow. I think that's the yen carry trade. Just my personal opinion. There's nothing to indicate that that's what it is. So here's the yield on the JGBs, which is now getting important because, as you know, the 30-year and the 40-year are shooting up. So far, the BOJ has been able to maintain control of the short end. It's the long end that's moving away from them. And this is important now because look at where the yields were here. Everything is basically below 2%, and for years, almost 10 years, it's below 1%, if not 0%. And during that period of time, look at the growth of the JGBs outstanding. And we already know who owns them, okay? So we've had this tremendous growth of the Japanese debt when the interest rates were 0 to 1%. Let's say highest at 2%, okay? So why do we care on that? Well, here's the thing. They have HTM, hold to maturity portfolios, also in Japan. So that means they're all holding those bonds at a big time negative, right? Billions upon billions, they're down, okay? So it doesn't matter if you're a foreign holder, if you're an investor, if you're the Bank of Japan, if you're the insurance companies, their bonds are down. And they are now holding all these losses on their portfolios. So why do we care about that? Well, you got to think about something here. You know, this is all wrapped up in the trade and the tariffs and the payment system and so forth. So as this guy points out in the second paragraph here, the supply chain is not merely a logistical framework. It's also fundamentally operates as an inverse payment chain. So if there's any disruption in global trade, we're going to see a disruption in the flows of monies around the world. Whether you're talking the yen, the dollar, it doesn't matter, right? This is what happens. Now you can stop and read this in the first paragraph, but basically it's if you order something from Japan, one of our guys, and they send it over here, it's T plus 30. And then the invoice takes another 15 days. So it's T plus 45, okay, days. That's what that is, all right? For the goods to be delivered and the payments to come back. And in that 45 days, we have to take it from April 4th, Liberation Day, which basically puts us at May 18th or 19th, all right? Today's the 21st. And so notice that the moment that we can actually point to there should be some kind of slowdown in the money flows coming back to Japan or to any other country it would start around May 18th, May 19th. Now, yesterday or the day before, all what happened here is the Japanese tried to bring out a 20-year bond. Well, guess what? They had very little bids for it. They didn't even bid the cover. And then secondly, people asked for a much higher rate. And that is why you're seeing the bond spike up now, because people saw that on the offering. Okay, so this is highly simplistic, but again, you know, they say it's better to do graphs, but you can see, you know, follow the money. So it goes from America to Japan and comes back, and what do? Either they put into the Japanese banking system, which go by the JGBs, or they go and invest it in US Treasuries. This is what happens. Now, what we're saying is with the tariffs and the slowdown in trade, there's less money in these money flows. There's just less money. And so that means there's less money buying things. So there's less money buying US Treasuries. There's less money buying the JGBs. It is what it is because of the tariffs and trade slowing down. Now, anybody who follows this channel, they know that I am far less afraid of, you know, China and Japan selling their treasuries. I am far more worried about that they don't buy them in the same volume that they have for the past, right? And just multiply this across the world. No matter what country you're in, remember something. We tariffed 182 countries. 182, there's 190. The bottom 8, you and I couldn't even name, Vanuatu or something like that. But we tariffed 182 countries. There's going to be a significant slowdown in fund flow, period, okay? And with this fund flow slowing down, we're going to experience, I believe, higher rates on our bonds. And basically, when you're looking around the world, right, you see on X or anybody else you follow, that the whole bond complex for every single country is moving up in yield, down in price. All because there's a general slowdown in money flows around the world. So I'm going to add in another country to watch. When we talk about the weak and the old, all right, you got Japan, but we also got Britain, all right? We got the gilts, and we have the pound, all right? And so you can see here that the UK inflation rate rose from 2.6 to 3.5%. Consensus was 3.3%. This is the highest inflation in 15 months. The problem here is the core inflation rate is 3.8%, which is also above consensus. And the markets immediately reduced their anticipated Bank of England rate cuts to only one this year. They had multiple, right? In fact, the Bank of England has lowered interest rates 4 times since August of 2024. Okay, 4 times. May 8th was the last time that they lowered this rate. This goes back to the video I made last week, that I'm seeing the countries, even though they're experiencing higher and higher inflation rates because of the tariffs, they don't care. They're lowering their interest rates, which in the end could mean inflation, all right? So here's the 10-year gilt at 447. This is a 5-year chart. So you can see we're right up there to break out and go to new highs here on the 10-year gilt. And here's the British pound. Remember, the British pound is like the Japanese yen. Up is down, down is up. And so now you have the British pound under stress. So again, I am not saying America is going to walk free on this. Like I said in the last video, it's who goes first. So we said first, we thought it was going to be Japan would be first. Second, I think it's going to be the Brits, all right? They have basically the same issues that Japan does. They just don't have the absolute crushing debt, but it's still bad. So they're the two I'm watching. What are you watching? Tell me in the comments, and like and follow.